Good day, investors. My name is Lawrence, and thank you so much for watching this channel. If it is your first time watching this channel, we mainly talk about investing in stock market, personal finance, and also how you can be financially independent. Today, I'm going to be talking about yet another investment option that has actually a lot of misconception, especially among low income earners, and I'm going to be actually uh, talking about this misconception and also how you can start investing from start to the end. So if you're interested definitely in treasury bonds, this is the topic that I'm going to be talking about. So mainly I'm going to be talking about what the treasury bonds are, how you can start, and also all the misconception about treasury bonds. Definitely, if you're not yet subscribed, please consider subscribing so that you don't miss out on other episodes that we are going to be sharing. So let's go directly into this topic. So definitely we must have to define what the treasury bond is and also what it's all about, the treasury bond. So specifically we are talking about treasury bonds in Uganda. So what is a treasury bond? So its basic definition you can say is that an instrument that the government of Uganda uses to borrow money from the public. So the public can be personal, it can be institutional, it can be any person who has money and also is interested in investing in treasury bond. So you can also put it in another way that actually it is the way people rent the government, and at the end of the day the government pays an interest on the income that the public is lending the government. So why are we extremely interested in this investment option? So that's what uh, because actually it has a very high interest compared to most of other investment option, as you're going to see in the next discussion. So basically we do have, like, you can say, long term and short term treasury bonds. So mainly the short term is always between 3 to 5 years, and this one attracts mainly the taxes of 20%. So from 10 years, 15 and 20 years, it attracts only 10%. So when I'm encouraging and when I'm investing in treasury bonds, definitely I always do invest in 10 years, 15 years, 20 years, because they do attract a less a less interest. I mean a less tax. So for example, 3 to 5 years, it attracts 20%. So 20%, definitely if it is subtracted to your interest, definitely it is a big blow. But if you investing in 10 years, 15 years, 20 years, it attracts a 10% tax. Just to clarify, the tax is only and only applicable on the interest you're earning, not the principal that you have invested. So basically, that's what it means. So you'll find also where most of the time treasury bills and treasury bonds go hand in hand. But for today, we are not talking about treasury bills, because treasury bills, for me, I do not invest in it because there are better options like money market fund where you can put your money rather than putting money in treasury bills. So today we are only concentrating on treasury bonds because that's what it is beneficial. So let's go to the next slide, which says why should you invest in treasury bonds. So when you're going to be investing in any investment, you should be having different investment options so that you can compare which one gives better returns, which one has you can say a defensive side where you can protect your capital, where you don't lose your capital, and also where else is it flexible? Can I do other things while I'm invested? So you have to look at different investment options before investing in any other investment option, so that you get uh, the best return on your investment, also without losing your capital. So the treasury bond, one, it is high, it has high returns. I haven't seen any other investment that actually returns as higher interest compared to treasury bonds, and which is not risky. For example, if you're doing your own business, definitely you will, like entrepreneur, they do get a highest return, but also the return is also almost equivalent to the risk, because they say most of the, actually, like in Uganda, more than 80% of the entrepreneurs, their business collapse before even a year. So that's how risky, for example, entrepreneurship is. But if it is profitable, it is more rewarding than definitely treasury bonds. But for example, if you're employed like me, or if you're doing something else, the treasury bond, you can put your money, and also it gives you the highest return. So let me show you what I'm talking about, because it returns between net 15 to 15.5 net of the taxes. But when you include the taxes, you find it's a 17.5%. So I'm going to show you one of the recently auctioned bonds by the Bank of Uganda, to give you the idea of how much the interest is, because sometimes people tend to say theoretical, but this is practical. So you go to Bank of Uganda, invitation to tender government bonds. So I'll just go there and see treasury bonds auction, of the treasury bond auction, and yields. So if you go to here and you say results of treasury bond auction, every month treasury bond, they do sell treasury bond once in a month. So I will start with the one for April, for example, 2025. How much was? So for example, the 2-year gave 15.75. 5-year bond gave 16.50, and the 15-year bond gave 17%. So if you go to 17%, for example, 17 times 0.90, it will give you 15.3. So net of the interest, for example, if you invested in 15-year treasury bond, you will get 15 net, which is extremely very rare in any investment world, to get 15.3. So if you get the 15-year times 0.80, because it does return 20%, 13 points. So you see the difference, almost 20% difference. So definitely investing in a long-term bond, it is rewarding. So let's see the recently auction, the one which was in May, 14th May. This was very interesting, actually. Even 3-year, 10-year bond, all of them, they were very high. If you follow the investments, definitely, and the treasury bond, during the election period, and also this is the time of reading the budget, definitely the treasury bond is going to be extremely very high, because the government needs more money and very few people are willing to lend it. So you can see the even 3-year bond gave 16.5, the 10 years bond gave 17. So if you multiply, for example, the highest, which is 17.945 times 0.90, so it gives you 16, a whopping 16% on your return. So this is extremely very interesting. If you know of any investment that returns 16% net of tax, that is very safe, let me know, so that we can also talk about it. So that's what I talked about. It is very safe. In the world, I've never heard of any government that has never paid a treasury bond. Of course, some countries like Ghana, like Zambia, they did defer. That's what you can say. They did not pay for a certain period, but they had to, you can say, schedule and started paying. So it can delay, but it cannot stop paying, because these bonds, treasury bonds, are extremely, very important to the governments, because it's the way they get money to pay salaries, to do infrastructures, to do developments. So it's extremely very important that they do not default on any of their treasury bonds. So definitely, third one is better than other investment options. For example, if you follow my channel, you know that we talk about investing in stock market. Stock market, actually, if you have the knowledge, for me, like the knowledge that I have, stock market is rewarding more than treasury bonds, but it is more riskier than the treasury bonds. So if you're going to be investing in the stock market, you have to know that actually it is rewarding but more riskier. So if you're risk averse, 100%, I do recommend to first invest in treasury bond. Then after like accumulating enough knowledge, then you can go to the stock market. So let's go to how should you buy treasury bonds, because this is the most important also part. If you're going to be investing in treasury bond, you should be knowing how you're going to be investing in the treasury bond. So the basic thing that you should be having, a bank account in any of the banks. Definitely, if you're in Uganda, Stanbic Bank, Equity Bank, Housing Finance, DFCU, a lot of banks, they do Centenary Bank. So all those banks are regulated, they are registered to sell and also process the bonds on behalf of their customers. So this is if you have an account, definitely the bank will give you this kind of it's called CSD, which is Central Securities Depository. So you will need, of course, the photograph, your national ID. Then this is the date of submission. So these are the details that you need: first name, last name, date if it is a company, so if it is an individual, definitely your name, gender. So these are the kind of details that you'll need to fill if you're interested in buying treasury bonds. So we are not going to do much on this, but this is the one that you're going to fill and submit in your bank if you're going to start purchasing treasury bond. So this one will be sent to the Bank of Uganda, so they will be having your own details. So basically, this is the form if you're going to be starting to buy the treasury bonds. So basically, you need an account. Then I already showed you the form that you fill. So let's say you have filled the form and you're ready to start buying treasury bonds. There are two things that you need to know. There is a primary and secondary market. So you can either buy directly from the Bank of Uganda, or you can buy from, you can say, the retailers, which are the banks. So the primary market is, as I said, you're directly purchasing from the Bank of Uganda. When you're talking of the industry terms, you're buying directly from the manufacturer. So which means it's a discounted price, which means you benefit more if you buy from the primary market. So secondary markets, it's like when we talk of the industry terms, it's like you're buying from the retailers, which means the price is slightly higher compared to the primary market. So how do you know that you're purchasing from the primary market, and how do you know that you're purchasing from the secondary market? So I also prepared the two forms. So this is the way it's CDS form 2. So this is how it looks like. It says bid application form. So if a form does not have bid application form, and it should be CDS form 2. The other one, secondary market, it is CDS form 4, but we are also going to be showing you. So this is the way it looks like. Just for your information, the minimum amount to start buying bonds, it's 100,000 Ugandan shillings. So, but if you have like more than less than 1 million, I wouldn't recommend you to buy from the primary market, because if you're buying from the primary market, the bank that is processing your bid, it will charge you a certain amount depending on which banks. So it can even go up to higher as 20,000. So for example, if you invest in 200,000 and they charge you 20,000, you can see that is almost 20% of the amount. So that is not good. So if you have like less 500, even less than 1 million, I would recommend that you buy from the secondary market, because secondary market you're buying from the banks directly, and they will not be charging you any fee, because as they say, they are direct sellers. But if you have 1 million and above, 100%, I recommend you use this form to buy directly from the bank. So as I said, this is the way it looks like. It's a CDS form 2 and says bid application form. This is the primary market, the way it looks like. So let's go to the secondary market form. It says this is the way it looks like. CDS form 4. Please do not confuse them, because sometimes the banks may feign ignorance and sell you, because of, as I said, they benefit if they do sell you from the secondary market, because they get some certain commission, because they buy from the bank cheaply and they will be selling to the individuals expensively. So that's how it is. And I said, of course, it only once in a month if you're buying a bond. So if you're not going to wait, you can also buy directly from the bank directly. If, for example, the 14th one, which we saw, it gave us 17%. So if you buy it on secondary market, you may be able to get around 16.5, depending on how much you have, because it's about negotiation. The more money you have, the more high interest rate you may be able to negotiate with the bank. So this is how it looks like if you're buying directly from the bank. So basically, these are the two forms that you should never ever confuse, because if you confuse them, you're going to get a less interest rate. So basically, if you're going to buy from the bank directly, at least you need to fill the form a week, so that the process is smooth, because the things need to be submitted to the Bank of Uganda, so the Bank of Uganda can process your bid. I recommend actually you can even fill it 2 weeks, 1 week, so that the bank doesn't have any excuse that they were not able to submit your bond application form. I hope this is extremely very, very clear, and you, by the time you're going to purchase the bond, you're not going to confuse this. So that is it. So we do have also what we call competitive and non-competitive bids. So if you're a smaller investor like me, you don't have 200 million, this does not concern you, because competitive bids, it means you have 200 million and above, and you're telling the government of Uganda, for me, I want 18% on my money. I want 20% interest on my money. But if you have less than 200 million, definitely you cannot do a competitive bid. You only have to apply, and whatever the Bank of Uganda gives is what you go with. In it takes, of course, the average of the competitive bid. So that's how you benefit. For you, if you don't have 200 million and above, you cannot do competitive bid. But as I said, whatever the competitive bids give, they do give an average. So definitely you don't lose out, even if you don't have that money, as it gives the highest possible average amount that competitive bid gave in. So that's how it is. So another question you may ask, Is it flexible? Can I withdraw my money if I need it? Because we saw 3, 5, 10 years, 15 years, 20 years bonds. But if, for example, if I get any problem, can I withdraw my money? The answer is an emphatic yes. But there is a caveat. Why? Because, as I said, if you purchased the bond at a higher interest rate, and for example, and you get an issue, the bank that is selling the bond might sell your bonds at lower interest rate. At the end of the day, you get lower money than you purchased. But if, for example, you have been with it, for example, you got an interest for just to note that the Bank of Uganda will be paying every 6 months. So in a year, it pays twice. So for example, if you have got your interest, for example, in a year, even if you sell, you cannot get any loss because you already got an interest. But for example, if you purchase today and next week you have an issue, you want to sell your bond, definitely you may sell it at lower interest rate, meaning you lose. So for example, in any investment, I always encourage people to have an emergency fund so that it does not, if in case you get any problem, you don't get affected by your investment, because every time you sell your investment before it matures, you are at a loss. So, but as I can say, you can sell it any day, any time of the day you want, but sometimes you may get a low interest, therefore you may lose on your money. Not much, it may be less, but you can lose slight money, but sell anytime, any time of the day. That's also why it is also very, very good investment option. So the big elephant in the room, because I've seen online, I've seen everywhere people saying the treasury bond are very risky. For example, in Uganda, it has unstable governments, for example. I want to remind you that since 1969, I think in Africa and the world, Uganda has had the most chaotic regimes in the world. For example, almost 90 presidents have changed power since 1964. So you see how chaotic the governments of Uganda have been. But since 1969, the government of Uganda has never defaulted on treasury bond. So I can assure you that actually, because I can say things are getting better, so you are assured that you're not going to be losing your money. 1969, Amin regime, Obote regime, Murutwa, Binaisa, now the president of Uganda, no one, because the way it works, this is the government of Uganda. When the regime goes, definitely the government remains, and for example, the Bank of Uganda, which is technical aspect, remains. Therefore, they keep on processing the bonds. That's how safe it is. Even if the the current government goes out, the technical wing of government of Uganda remains, and the government keeps on running. So there's nothing to be actually. Unfortunately, this is a tip. The more unstable the government is, the higher the interest. So, because the people are not willing to borrow to lend the government because of the chaotic system, that's why, for example, during the political tensions, the bonds tend to go higher because many institutions are not willing to lend the government. So they pay high interest rates for that risk. For example, currently, as I said, it is almost 18. Maybe by next year, it may even reach up to 19 because of the political season. That's how good you can say during the political tensions. Of course, we wouldn't want that because the more the interest is higher, it affects the businesses in Uganda because, for example, the banks are not willing to risk money on individual lenders, borrowers. They would rather lend the government. So that's why it's not good when you see the bonds are very high. It means there will be no capital to the borrowers, to the retail borrowers who want capital. So that's why you should never wish for example, if you're in the business world, you should never wish the treasury bonds to be extremely very high, because if they are higher, there will be less capital, as most of the banks, most of the capital providers will be borrowing to the government. Will be lending to the government, or there will be limited money to borrow to the retailers. So that's how it is. So I've really, I believe I've answered all your questions, all your worries, and actually is also another misconception that treasury bonds is for the rich, is for the largest institutions. As I said, the minimum capital is 100,000. So of course, if you have more money, the more interest you get. It is all everywhere in the world that the more money you have, the more benefits it gives you, but doesn't mean that also small investors like us cannot buy bonds 100%. You can buy bonds, you can keep on accumulating bonds. Definitely, the more money you have, the more interest you will get, but it doesn't mean that if you have less money, you cannot invest. In fact, if you have less money, the higher chances of investing, because you can grow your money slowly without being put on pressure. As I said, if you're not invested, if you're not subscribed, definitely you're missing out, because we do talk about these things: investing in the stock market, personal finance, and how you can be uh, financially independent. If you have been with us up to here, I thank you so much for watching, and once again, have a wonderful day. Goodbye.